Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We have some exciting updates in the financial world. Plus, we'll cover the impressive 49% jump in Indian Overseas Bank's Q1 profit, reaching Rs 1,659 crores, highlighting strong banking sector performance. So stay tuned as we delve into these key topics and what they mean for you.
Absolutely, Vijendra. We'll be discussing India's 10-year bond yield easing to 6.77%, a significant development for investors and the economy. And finally, we'll talk about how banks are actively pushing FCNRB deposits ahead of the September 30th deadline, an important move for NRIs and the banking industry.
India's benchmark 10-year government bond yield rose to 6.7710% on July 14th, up 4 basis points, mainly due to a weaker rupee at 95.94 against the US dollar and Brent crude prices surging above $85 per barrel. June's retail inflation hit a 15-month high of 4.38%, driven by rising food and fuel costs, worsened by the West Asia conflict and hawkish US Federal Reserve signals hinting at further interest rate hikes. Let's look at another key development. Indian Overseas Bank posted a strong first quarter with profit after tax jumping 49.34% year-on-year to Rs 1,659 crores. Net interest income also surged 34.30% to Rs 3,688 crores. Segment-wise, retail banking led income growth, generating Rs 4,987 crores, up 38.44% year-on-year. Treasury operations and corporate banking also contributed to total income of nearly Rs 10,938 crores.
The rupee's depreciation and higher crude prices reflect escalating geopolitical tensions in West Asia, especially the US blockade on Iranian shipping, which threatens India's energy imports of approximately 85% and pushes inflation and bond yields upward. This combination creates pressure on Indian debt markets, raising bond yields and uncertainty about inflation and interest rates, complicating borrowing costs and investment decisions in the near term. That growth reflects improving asset quality, with the gross non-performing asset ratio dropping to 1.33%. The return on equity climbed sharply to 22.69%, showing better capital efficiency in a competitive banking market. This diversified revenue base and rising net interest margin of 3.37% suggest Indian Overseas Bank is strengthening its market position while maintaining profitability amid sector challenges.
Let's move on to our next article. Banks are pushing foreign currency non-resident rupee-denominated deposits aggressively before the Reserve Bank of India's September 30th deadline. Initial inflows were slow, but they expect momentum to build as investors often decide closer to the deadline. Public sector banks report mixed results. For example, Punjab National Bank raised $425 million towards a $2.5 billion target. Private banks show strong demand but face operational pressure and margin concerns. Let's look at another key development. Canara Bank paid annual interest totaling Rs 904.8 crores on July 20th, 2026. The largest amount, Rs 740 crores, was on long-term infrastructure bonds, while Rs 164.8 crores was on Basel III compliant additional Tier 1 bonds. The infrastructure bonds have an issue size of Rs 10,000 crores, with interest paid punctually on the due date. The additional Tier 1 bonds total Rs 2,000 crores in issue size, with interest payments aligned to SEBI guidelines.
The market sees strong interest in Middle East, Singapore and Hong Kong, though tax issues in some regions limit participation. Banks are expanding NRI engagement and partnerships globally to boost collections. Analysts forecast total inflows around 50 to 55 billion US dollars, below earlier 70 billion projections, due to higher US interest rates reducing appeal compared to the 2013 scheme. This timely payment reflects strong compliance with SEBI regulations and operational discipline. Adjusting record and coupon dates due to holidays shows the bank's commitment to transparent bond servicing and maintaining investor confidence in the debt market. Maintaining strict adherence to payment schedules underlines Canara Bank's reliability in honoring debt obligations, which is critical for investor trust and market stability in India's banking sector.
Here's another significant update. Corporate lending at top Indian private banks grew by 26% year-on-year in the June quarter, outpacing retail loans which grew around 10%. This surge was driven by rising bond yields, pushing companies back to bank credit for working capital. Exactly. HDFC Bank saw 18.6% corporate loan growth versus 7.2% retail. Axis Bank and Yes Bank reported even higher corporate loan increases, 38% and 41% respectively, highlighting a clear shift in lending focus. Let's look at another key development. India's private credit market is projected to grow from 25 to 30 billion US dollars today to 100 billion US dollars by the year 2050, driven by deeper capital pools and more experienced market players. Regulatory oversight is crucial as the sector matures. Indian authorities are cautiously advancing reforms to build investor trust, maintaining a relatively stable environment compared to international markets.
That explains the overall bank credit growth of 18.6% by June 30th, the fastest in over 2 years. Higher bond yields made bank loans more attractive, especially with the 10-year government bond yield averaging 6.99%. The working capital demand was strongest in sectors like commercial real estate, infrastructure, metals, and food. This broad-based recovery signals a strategic borrowing shift as companies opt for bank credit over costlier bonds. This growth aligns with an increase in family offices and ultra-high net worth individuals investing in alternative assets, which broadens capital availability and professional fund management. Also, the National Pension System Trust plans to enable pension funds to invest in private credit, signaling institutional acceptance and supporting the market's long-term expansion.
Now, let's discuss another important development. The Reserve Bank of India accepted bids worth Rs 14,497 crores in its bond switch auction, less than half of the Rs 30,000 crores initially targeted. This was due to yields offered exceeding the RBI's acceptable limits. Exactly. Bond switch auctions help extend debt maturity, reducing pressure from lump sum repayments. So, by limiting acceptance, RBI keeps borrowing costs manageable without compromising fiscal stability. Now, let's discuss another important development. The Indian rupee opened at 96.41 against the US dollar, depreciating by 6 paise from 96.36. This drop is mainly due to rising crude oil prices and demand for the US dollar amid geopolitical tensions. Domestically, the Sensex fell by 58.89 points to 77,649.63, while foreign institutional investors sold equities worth Rs 1,121 crores, showing market caution.
This selective acceptance highlights the RBI's cautious stance to avoid high borrowing costs. By accepting only part of the bids, they balance cost efficiency while managing government debt redemption smoothly over time. Market participants see this as prudent debt management. It reflects RBI's priority on sustainable debt profiles amid volatile market conditions, which supports long-term economic balance. The firmer dollar is reflected in the dollar index at 100.97, up by 0.03%. Elevated oil prices and Middle East conflicts are keeping energy market risks high, pressuring the rupee further. This combination of global tensions, commodity prices, and capital outflows creates volatility in both currency and equity markets, signaling continued uncertainty for investors in the near term.
Now let's discuss another important development. The Export-Import Bank of India is raising $300 million via 3-year floating rate bonds priced at 90 basis points over the secured overnight financing rate, using the Reserve Bank of India's subsidized hedging facility to lower currency risk costs. Notably, this will be Exim Bank's second dollar bond issue in 2026, complementing its January offerings of 10-year bonds at 5% coupons and 30-year bonds at 5.75%, diversifying its foreign currency debt portfolio effectively. Now let's discuss another important development. TVS Motor Company allotted non-convertible debentures worth Rs 500 crores at a 7.30% annual coupon, maturing in 3 years on July 17, 2029. The debentures are unsecured and carry no special privileges, but a penalty interest of 2% per annum applies if payments are delayed beyond 3 months.
This move fits a broader trend, with Indian institutions tapping cheaper foreign currency funds through the RBI's new framework. It's pushing bond issuances, expected to reach around $5 billion by September, as borrowers seek to lock in favorable rates amid currency volatility. The RBI's subsidized facility is clearly encouraging both state and private entities to raise cheaper external commercial borrowings, which could stabilize costs and boost the Indian financial sector's global funding capabilities in the near term. This issuance via private placement on the National Stock Exchange reflects a moderate cost of capital, supporting their strategic funding needs without diluting equity. That penalty clause safeguards investors, making these NCDs attractive despite being unsecured, balancing risk with a decent yield in today's market.
Let's look at another key development. Shapoorji Pallonji Group raised approximately Rs 15,100 crores through one of India's largest private credit deals, signaling strong investor confidence amid global volatility. The funds will refinance rupees 15,500 crores of Goswami Infratech debt via 3-year zero-coupon rupee bonds yielding 18.95% per annum. Now let's discuss another important development. Manba Finance will discuss its first quarter financial results for fiscal year 27 on July 28 at 2 p.m. Indian Standard Time. The Managing Director and Chief Financial Officer will share insights on operational performance and strategic direction. Notably, Mamba Finance's stock showed mixed returns, a decline of 0.15% in the last trading day, but a 5.09% gain over 1 month. The 5-year return, however, is down by 9.62%.
This highlights growing trust in India's private credit market, especially for large leverage transactions supported by both domestic and global investors. Refinancing now improves liquidity for the group, backed by stakes in Afcon's infrastructure and Tata Sons, aiding debt repayment of 13,500 crores within 2 years. The call was made by the group spokesperson, who said that the company was committed to meeting its obligations and that it was working to resolve the issue as quickly as possible, 100 crores within 2 years. The call is hosted by DAM Capital Advisors Limited, with dial-in access for domestic and international investors. This transparency is key amid recent stock volatility, giving participants a chance to understand the company's position directly from leadership. These mixed signals highlight underlying challenges. Investors will watch the earnings call closely for clarity on how Manba Finance plans to address long-term headwinds while managing short-term market fluctuations.
Moving to our next story, Reliance Industries posted a 6.1% year-on-year profit rise to Rs 23,196 crores in Q1 of fiscal year 27, driven by a 25.4% revenue jump to Rs 3,11,850 crores. EBITDA hit a record Rs 54,067 crores, up 10.1% year-on-year, but margins dipped to 15.9% from 18%, reflecting higher costs and investments. Let's move on to our next article. Punjab National Bank's standalone net profit soared to Rs 5,253 crores in Q1 of fiscal year 2026, a rise of 213.6% from last year. This was mainly due to provisions dropping sharply from Rs 3,231 crores to Rs 541 crores. Additionally, net interest income increased by 2.1% to Rs 10,798 crores, and operating profit rose 6.2% to Rs 7,519 crores. The return on assets improved markedly to 1.04%.
That growth reflects strong performances in oil to chemicals, retail, and digital services. Market response is positive, with brokerages forecasting robust expansions, especially in Geo and O2C, and retail EBITDA expected to double over 3 years. Despite margin pressure, new energy projects and the upcoming digital services IPO signal strategic growth, balancing short-term margin compression with long-term value creation. That's significant, Vijendra. The improvement in asset quality also helped, with gross non-performing assets falling to 2.78% and net NPAs to 0.28%. This signals better credit health and supports sustained profitability. The capital position strengthened as well, with the capital adequacy ratio under Basel III norms rising to 18.13%, and the Common Equity Tier 1 ratio at 14.52%, reflecting robust financial stability.
Here's another significant update. Soba Limited's board approved raising up to Rs 1,000 crores through non-convertible debentures on a private placement basis, aiming to boost financing flexibility and strengthen their capital structure. The issuance will be in one or more tranches, with the investments committee finalizing terms like tenure, coupon rate, and security details later, maintaining regulatory compliance. Let's move on to our next article. Kotak Mahindra Bank's consolidated net profit rose 23% to Rs 5,480 crores in Q1 fiscal year 27, driven by a 16% increase in customer assets to Rs 5,70,901 crores. Also notable is the strategic move to acquire Deutsche Bank's retail and wealth businesses in India, involving advances around Rs 29,000 crores, pending regulatory approval, which could significantly expand Kotak's market share.
This aligns with the sector trend of diversifying funding amid strong residential demand. Private placement allows SOBA to efficiently manage liquidity and capital, supporting ongoing projects and expansion without public offering complexities. Offering NCDs to institutional investors underlines SOBA's strategic approach to stable funding, enhancing financial stability in a competitive real estate market. That growth signals strong market confidence. The bank's operational efficiency remains solid, with a cost-to-income ratio at 45.6%, alongside improved asset quality as gross non-performing assets fell to 1.18%. This acquisition, combined with robust returns, return on assets at 2.18% and equity at 11.90%, positions Kotak well for sustained growth despite recent stock volatility.
Moving to our next story, Grasim Industries invested nearly rupees 74,000 crores in capital expenditure over 5 years, signaling strong confidence in India's growth and expanding their capacity across sectors. In fiscal year 2025 to 26, Grasim recorded consolidated revenue of rupees 1,75,431 crores, an 18% increase year-on-year. Now, let's discuss another important development. Axis Bank's standalone net profit rose 23% year-on-year to rupees 7,114 crores in Q1 ending June 2026, driven by a 6% income increase and a 44% drop in provisions. On the consolidated level, net profit reached rupees 7,632 crores, boosted by fresh equity infusion into subsidiaries. Brokerages like Bernstein and Jefferies remain bullish with outperform and buy ratings.
This investment aligns well with India's rapid economic expansion, particularly in infrastructure and manufacturing, boosting market confidence in Grasim's long-term prospects. Such growth, along with Ultratech Cement's capacity reaching over 200 million tons per annum, solidifies their leadership and ability to capitalize on India's infrastructure boom. That's significant. The bank's asset quality also improved with gross non-performing assets down to 1.28% year-on-year, supporting its strong market position in retail and digital banking revenues. Positive outlooks reflect confidence in Axis Bank's loan growth and earnings momentum, despite some margin pressure. This bodes well for its continued leadership in private sector banking.
Let's move on to our next article. By June 2026, Unified Payments Interface had 55.49 crore users, with transaction volume hitting 24,162 crore and value reaching rupees 314 lakh crore in fiscal year 2025 to 26. Internationally, NPCI International Payments Limited is expanding UPI and RuPay to 9 countries for person-to-merchant and 3 for person-to-person transactions, including Nepal, Greece, and Singapore. Security-wise, the government, Reserve Bank of India, and NPCI have implemented risk-based limits, protections against unauthorized mobile changes, and new frameworks like the Comprehensive UPI Information Security Framework 2025. Let's look at another key development. The Reserve Bank of India's Special Overseas Deposit Program raised $17.4 billion via foreign currency non-resident bank deposits. This boosts rupee liquidity by allowing banks to swap these dollar inflows at near zero cost, easing short-term borrowing costs significantly. However, high Brent crude oil prices at $88.65 per barrel and Gulf tensions pose inflation risks. These factors could widen India's trade deficit, limiting how much bond yields can fall despite the liquidity boost.
That's a significant scale, showing UPI's dominance in India's digital payments. Such volumes reflect deep penetration and trust, critical for ongoing fintech growth and inclusion across urban and rural areas. This global push enhances cross-border payments for Indians abroad, while helping partner countries build their own real-time payment systems, fostering international fintech collaboration and convenience. These measures, alongside public awareness and training, strengthen user confidence and help mitigate fraud, ensuring the secure, sustainable growth of India's digital payments ecosystem. That liquidity injection has softened swap rates, reducing funding stress and lowering yields on short-term instruments. This supports the 10-year benchmark government bond yields around 6.7%, despite no formal interest rate cuts by the RBI. So while RBI's initiative improves liquidity and eases funding conditions, persistent macroeconomic pressures from oil prices keep upward pressure on yields, balancing the positive impact on the bond market.
Here's another significant update. SEBI fined Central Depository Services Limited 1 crore rupees for cybersecurity failures after malware attacks caused outages, lasting nearly 47 and 55 hours. This disrupted investor access and settlement processes critically. The fine, though modest, highlights regulatory focus on operational resilience. Investors will watch CDSL's next steps in infrastructure strengthening and compliance closely. Let's look at another key development. Trade and NBFC credit surged to rupees 34.5 trillion by May 2026, up from rupees 9.7 trillion in fiscal year 2018. This growth is driven by GST adoption, digital payments, and formalization of smaller businesses. Absolutely. Bank lending to NBFCs jumped from rupees 5 trillion in fiscal year 2018 to rupees 20.7 trillion in fiscal year 2026. with year-on-year growth hitting 33.7% in May 2026.
Such prolonged downtime undermines market confidence. SCBI's action signals stronger oversight on IT security, pushing CDSL to urgently upgrade its cybersecurity and disaster recovery systems. Indeed, further SCBI mandates or audits could raise costs and reshape CDSL's priorities, impacting its role in securities market stability. That's significant. The formalization and technology have improved lenders' ability to assess cash flows, increasing credit access. Banks now see NBFCs as crucial partners, especially those with strong capitalization and diversified funding. This reflects NBFC's role in underserved sectors like vehicle finance and MSMEs. Banks and NBFCs are now interdependent, with banks focusing on well-capitalized NBFCs with robust asset quality.
Moving to our next story, Aditya Birla Capital aims to double assets under management to Rs 3,20,000 crores by 2029, up from Rs 1,59,916 crores in fiscal year 2026, driven mainly by strong growth in retail and SME lending. The group's housing finance arm targets Rs 1 lakh crore AUM within 2 to 3 years, up from Rs 47,452 crores, boosted by a Rs 2,750 crore equity infusion from Advent International. Let's move on to our next article. Karur Vysya Bank's Q1 profit soared by 45% to Rs 756 crores, driven by a 32% rise in net interest income to Rs 1,423 crores. Advances also grew 17%, crossing Rs 1,04,000 crores. Asset quality remained stable, with gross non-performing assets at 0.74% and net NPAs at 0.19%. Maintaining this will be key as the loan book expands and the bank manages weaker segments.
His focus on diverse retail and SME loans, which form 68% of the lending book, helps stabilize growth amid market volatility, supporting sustainable credit expansion in a competitive environment. That capital infusion strengthens financial flexibility and supports aggressive loan growth while ensuring regulatory capital adequacy, crucial for maintaining stability as interest rates fluctuate. That's impressive growth, especially with the net interest margin up to 4.3% from 3.9%. The bank's focus on retail, agriculture, and MSME loans, which grew 18%, clearly helped, though vehicle loans declined by 21%. Investors will watch if the bank can sustain margin improvements and control credit risk, especially given the mixed signals from vehicle finance and cautious share price reaction.